Private Equity, From Fund to Exit, a complete practical guide by CandiMentor, CandiMentor.com. Hello and welcome to CandiMentor. Today we're decoding private equity, from the first rupee raised to the final exit. No jargon, no fluff. By the end of this session, you'll understand how funds are raised, how companies are bought, how value is created, and how money finally flows back to investors. You'll also learn critical terms like NAV, valuation methods, waterfalls, carried interest, and core accounting entries. Let's begin. 1. What private equity actually is. At its core, private equity means investing in companies that are not listed on a stock exchange. Sometimes it also means taking a public company private, improving it, and later selling or relisting it. The process follows a cycle. Raise money, buy a company, improve it, exit, return cash. How is it different from stock market investing? In public markets, you can sell your shares tomorrow. In PE, your money is locked up for years. Public companies must publish results every quarter. In PE, information is private and negotiated. Public investors are passive. PE is active and hands-on. You sit with management, redesign operations, and sometimes even bring in a new CEO. Who provides the money? Large, sophisticated investors, pension funds that manage retirement savings, insurance companies that need long-term returns, university endowments, sovereign wealth funds of countries, family offices, and very wealthy individuals. These investors are called limited partners, LPs. They provide the capital but don't control the day-to-day. The fund managers are called general partners, GPs. They make the decisions, run the deals, and are held responsible. Number 2. How funds are structured. A PE fund is typically set up as a limited partnership. Think of it as a legal wrapper. LPs commit the capital. Their liability is limited to the money they invest. The GP manages the fund. They choose deals, oversee portfolio companies, and charge fees. Important documents. The Private Placement Memorandum, PPM, explains the fund's investment strategy, risks, and structure. The Limited Partnership Agreement, LPA, is the rulebook. It defines fees, voting rights, profit sharing, and the all-important waterfall. Side letters are one-off agreements, giving certain LPs extra rights or clarifications. Key timelines. The typical fund life is 10 to 12 years. The first 3 to 5 years are the investment period, when new companies are acquired. The remaining years are the harvest period. The focus is exits, cash distributions, and winding down. So the fund is not eternal. It's more like a project with a clear beginning and end. 3. The private equity life cycle. The journey of a PE fund has 5 clear stages. Stage 1. Fundraising. The GP goes on the road, meeting potential LPs. They showcase their track record, investment strategy, and proposed terms. LPs then commit money, but they don't wire it yet. Stage 2. Capital calls. When the GP finds a deal, they issue a capital call. LPs are legally bound to transfer their share, usually within 10 to 15 days. Stage 3. Deal execution. This is the heart of the action. The GP sources a company, often through banks, advisors, or direct relationships. They sign an indication of interest, IOI, or a more formal letter of intent, LOI. They run due diligence, financial, legal, tax, and operational checks. They negotiate debt and equity financing. Finally, they close the deal. Stage 4. Value creation. The GP now works with the management team. They may improve pricing and product mix, cut unnecessary costs, free up working capital by collecting cash faster, upgrade the technology stack, professionalize leadership, add bolt-on acquisitions. This is where PE builds its reputation, turning good companies into great ones. Stage 5. Exit and distributions. Once value has been created, the GP looks for an exit. Auctions include a strategic sale to a bigger company, a secondary sale to another PE fund, an IPO, or a dividend recapitalization. The proceeds are then shared back with LPs as per the waterfall rules. Options 4. Core strategies you will hear about. Private equity isn't one single style. It's a toolbox of strategies. LBO, leveraged buyout. This is the classic. Use debt plus equity to buy control. Debt magnifies both upside and downside. Growth equity. Minority investments into promising companies to accelerate growth without taking full control. Venture capital. Very early stage, high risk, high return. Like buying a lottery ticket, but with analysis and networks. Distressed or turnaround investing. Buying struggling companies cheaply, fixing them, and selling once they recover. Very hard, but can deliver huge gains. Sector specialists. Some funds focus only on healthcare, technology, energy, or consumer goods. Specialization gives them sharper insights and better networks. 5. How value is actually created. Let's zoom in on the engines of returns in PE. There are 3 levers. 1. Multiple expansion. Buy at 8 times EBITDA, sell at 10 times. The company is now perceived as higher quality or in a better market. 2. Earnings growth. Grow EBITDA from 100 to 160. This comes from revenue growth, cost control, and better operations. 3. Deleveraging. Use company cash flows to steadily pay down debt. As debt shrinks, the equity slice gets larger and more valuable. The operational playbook. PE firms don't rely on luck. They use tested playbooks. Pricing and product mix discipline. Salesforce effectiveness. Training, incentives, channel optimization. Procurement and supply chain savings. Zero-based budgeting. Question every cost from scratch. Working capital release. Collect receivables faster. Optimize inventory. Add-on acquisitions. Merge small players to build a larger platform. Professionalize management. Hire CFOs. Build governance boards. Digital and data initiatives. ERP upgrades. Dashboards. Automation. The 100-day plan. Execution starts immediately after closing. Weeks 1 to 2. Secure cash. Check risks. Stabilize operations. Months 1 to 3. Capture quick wins. Pricing tweaks. Renegotiating supplier contracts. Headcount optimization. Quarters 2 to 4. Build long-term systems. Redesign the organization. Invest in growth bets. The rule: write it down, own it, track it relentlessly. 6. Measuring performance. IRR, MOIC, DPI, TVPI, RVPI. Private equity careers live and die by these 5 metrics. They decide whether a fund is good or average. They also decide how much carry the GP takes home. MOIC, multiple on invested capital. This is the simplest measure. Take the total value created. Divide it by the total equity invested. Example, if you invest 100 rupees and return 250 rupees, your MOIC is 2.5 times. It ignores timing. It's just a multiple. IRR, internal rate of return. This is the most quoted metric. It's the annualized percentage return that makes the net present value of cash flows equal to 0. Sounds technical, but think of it as a time-sensitive measure. If you return cash early, IRR shoots up. If you return the same cash 5 years later, IRR collapses. DPI, distributed to paid in. This measures pure cash on cash that LPs have actually received. Formula: cash distributed divided by cash invested. If you put in 100 rupees and have already received back 80 rupees in distributions, DPI equals 0.8. RVPI, residual value to paid in. This is what's still left in the ground. It measures the unrealized value of the portfolio compared to cash invested. TVPI, total value to paid in. This is simply DPI plus RVPI. So what you've already realized plus what is still on paper. Rule of thumb. Great funds aim for TVPI above 2.0 times and DPI above 1.0 times by the mid to late years. But context matters. Strategy, cycle, leverage, and risk appetite all affect these numbers. 7. Valuation and fair value hierarchy. Every quarter, PE funds must report fair value of their holdings. This is done under INAS, IFRS, or US GAAP, depending on jurisdiction. The hierarchy of fair value inputs. Level 1. Direct, quoted prices from active markets. Rare in PE because portfolio companies are private. Level 2. Observable inputs. For example, trading multiples of comparable public companies. Level 3. Unobservable inputs. Discounted cash flow models. Private transaction comparables. This is where most PE assets fall. Valuation methods used. Market approach. Use trading comps, peer companies, or transaction comps, M&A deals. Income approach. Classic DCF model, projecting cash flows and discounting them at an appropriate rate. Calibration. Start with the entry price as the benchmark, then adjust each quarter for performance and market shifts. For audit readiness, documentation is crucial. Show the method you chose, key assumptions, data sources, sensitivity analysis. For example, if revenue growth is 200 basis points lower than expected, the fair value might drop 8 to 10%. That sensitivity must be noted. Always keep a valuation memo. Update it each quarter. This is what auditors, LPs, and regulators will look for. 8. NAV and fund accounting, the practical flow. NAV means net asset value. Formula: assets minus liabilities at fair value. Assets include portfolio investments at fair value, cash, receivables, dividends, interest, sale proceeds, deferred expenses. Liabilities include accrued expenses, management fee payable, audit fee, custody and admin costs, carried interest accruals, any fund-level debt. What moves NAV? Capital calls, increase cash and partners. Capital. Distributions, reduce cash and partners' capital. Fees and expenses, reduce NAV. Valuation gains and losses flow through P&L and then to equity. Example calculation. Start of quarter NAV equals 1,000 rupees. Add valuation gain equals plus 60 rupees. Subtract fees and expenses equals negative 15 rupees. Subtract distribution paid equals negative 40. Ending NAV equals 1,005 rupees. Common journal entries. Valuation gain, debit investment, FV uplift, credit unrealized gain P&L. Management fee accrual, debit management fee expense, credit management fee payable. Audit fee accrual, debit audit expense, credit accrued liabilities. Dividend received, debit cash, credit dividend income. Distribution to LPs, debit partners capital, credit cash. These entries may look simple, but consistency and accuracy are what make fund audits smooth. 9. Fees, carry, hurdles, and the waterfall. This section is the money plumbing of private equity. Management fee. Usually 2% per year on committed capital during the investment period. After that, it steps down to a percent of cost or NAV. Hurdle rate and carry. The hurdle is the minimum return LPs must receive first, often 8% IRR. After that, a catch-up provision allows the GP to take a large share until their agreed carry is reached. Finally, carry is the GP's share of profits, usually 20%. Waterfall sequence, deal by deal or whole fund, return of capital to LPs. Preferred return, hurdle to LPs, GP catch-up, residual profit split, often 80-20 between LP and GP. Clawback, if the GP took more carry than they should have, they must pay it back at the end of the fund. Tiny numeric illustration. Suppose realized profits after returning capital equals 100 rupees. The hurdle is already met. After catch-up, the split is 80% to LPs and 20% to GP. That means 80 rupees to LPs, 20 rupees to GP. 10. LBO capital structure and debt basics. An LBO, or leveraged buyout, is the classic PE deal type. The idea: use debt to amplify equity returns. The capital stack: revolver, a flexible working capital credit line. Term loan, senior secured long-term debt. Mezzanine, or PIK, payment in kind. Subordinated debt, higher interest, sometimes with warrants. Equity, the GP's fund capital. Why leverage helps? If EBITDA grows and debt is paid down, the equity value balloons. For example, a company worth 1,000 rupees with 60% debt and 40% equity can deliver far higher equity returns than an all-cash deal, as long as performance improves. But risk cuts both ways. If EBITDA falls, equity gets wiped out faster. Debt magnifies losses as much as it magnifies gains. That's why GPs track interest coverage ratios, EBITDA versus interest expense, leverage multiples, debt over EBITDA, covenant headroom, how close you are to breaching loan terms. In short, debt is the sharpest tool in the PE toolkit. It can build fortunes or destroy them. 11. A simple paper LBO. Back of the envelope. Let's run a toy example of a leveraged buyout. The target company has EBITDA equals 150 crore. We pay 10 times EBITDA, so enterprise value is 1,500 crore. We finance it. 60% debt equals 900 crore. 40% equity equals 600 crore. Now fast forward 5 years. EBITDA has grown to 200 crore. Exit multiple is still 10 times. So exit enterprise value equals 2,000 crore. At exit, net debt is 400 crore. We repaid 500 crore over time. That means exit equity value equals 2,000 minus 400 equals 1,600 crore. We put in 600 crore. We take out 1,600. That's a MOIC of 2.67 times. Over 5 years, the IRR is about 21 to 22%. Of course, this ignores fees, taxes, and transaction costs, but it shows the mechanics of how leverage magnifies equity returns. 12. Accounting touchpoints you will be asked about. Interviewers often test whether you understand fund accounting mechanics. Here are common scenarios. 1. Valuation adjustment. Fair value drops $25. Entry. Debit unrealized loss, P&L, $25. Credit investment at FV, $25. Result. P&L falls, NAV falls. Partners' capital falls. 2. Partial exit. Sell 30% stake. Remove 30% of the carrying value. Book realized gain or loss on that portion. Record cash inflow. Deduct transaction costs. Revalue the remaining 70% stake at fair value. 3. Dividends from portfolio company. If received, debit cash, credit dividend income. If declared but not received, debit dividend receivable, credit dividend income. 4. Delayed capital call. Until cash is actually wired, show it as subscription receivable. Liquidity planning changes, but NAV only changes when real cash moves. 5. Defaulting investor. Reclassify the unpaid amount to due from investor. Apply penalties as per LPA. May lead to reallocation or a forced sale of the investor's interest. 6. Intercompany balances. GP versus fund. Eliminate reciprocal balances in consolidation. Otherwise, you double count assets and liabilities. 7. Carried interest accrual. When hurdle and performance tests are met, debit carried interest expense, credit carried interest payable. If later performance drops, reverse it. Always respect clawback and escrow rules. 13. Valuation governance and audit readiness. Quarterly valuations must be controlled and documented. A good valuation file includes company performance versus original plan, method used and rationale, peer multiples, transaction comps, and data sources, discount rate buildup for DCFs, sensitivity tables, what if growth is lower, margins compress, multiples contract, calibration to entry price, management representations and board minutes, sign-offs from the valuation committee. Auditors expect consistency, evidence, and controls. If your file is clear and complete, audits go smoothly. If not, expect long questions and delays. 14. Controls and reconciliations that keep you out of trouble. PE fund accounting is high risk. Small mistakes can damage credibility. That's why controls matter. Key practices: cash controls, dual approvals, daily bank reconciliations. Capital account reconciliations. Match fund administrator records with manager records, investor by investor. Fee and expense policies. Define clearly what is a fund expense versus what the GP must bear. Cutoff and accruals. Always book in the correct period. Valuation committee. Maintain independence. Document minutes. Change logs. Track who made what change and why. Disaster recovery, backups, and recovery drills. These basics protect you from errors, disputes with LPs, and regulatory fines. 15. Tax and structures, a fast, practical tour. Tax planning is not just compliance, it is part of PE strategy. India, alternative investment funds, AIFs, are divided into category I, II, and III. Each has different pass-through rules and tax treatments. U.S. investors, if they invest offshore, they may need K1 equivalents. Sometimes, funds use blocker corporations to avoid issues like ECI, effectively connected income, and UBTI, unrelated business taxable income. Cayman Islands, common as a fund domicile, flexible regulation, established service providers, withholding taxes and treaties. These affect cross-border dividends and interest. Structures are designed to optimize treaty benefits. Deferred tax. When book values and tax bases differ, deferred tax arises. You must track reversals carefully. The rule: always align the tax structure with fund strategy, investor profile, and substance rules. Tax-efficient structuring can add real percentage points to LP returns. 16. Risk management in plain language. Private equity returns are powerful, but so are the risks. Let's break them down in plain language. Leverage risk. If a downturn hits, can the company still service its debt? Leverage magnifies gains, but it also magnifies pain. Execution risk. Can management actually deliver the value creation plan? Strategies on paper are easy. Execution in real life is hard. Valuation risk. Did you overpay at entry? If you pay too high a price, even great operations may not save returns. Concentration risk. Too much exposure to one sector or too few portfolio companies. Diversification matters. Liquidity risk. Exit markets can freeze. IPO windows shut. Strategic buyers may pull back. How do funds mitigate these? Use strict underwriting discipline before buying. Negotiate debt covenants to create buffers. Stage value creation in manageable steps. Hedge currency or interest rate exposures where needed. And plan exits early, sometimes years in advance. Risk management is not about eliminating risk. It's about understanding and controlling it. 17. Technology that modern funds use. Today, technology is transforming PE operations. But remember, tools work only if the underlying process is sound. Fund accounting platforms include eFront, Investran, Allview, and Geneva. These handle NAVs, capital accounts, and investor reporting. Data pipelines now connect directly to portfolio company ERPs. APIs feed financial and operational data into BI dashboards in near real time. NAV validation engines use rules and exception workflows to flag discrepancies before reporting. AI and machine learning are entering the picture, detecting anomalies in KPIs, forecasting cash flow, flagging covenant risks early. Some firms are even experimenting with blockchain and triple entry accounting. This creates tamper-evident logs, speeds up audits, and reduces reconciliation work. But the golden rule remains: fix the process first, then automate. 18. Short scenario clinic. Common interview traps. Let's practice some quick scenarios that often trip candidates in interviews. A. IPO mid-year. The company lists its shares. You sold part, but not all. For the sold portion, book realized gain. For the unsold portion, mark to market at share price, minus a liquidity discount if justified. Update NAV and disclose clearly. B. Dividend recapitalization. The company borrows and pays out a dividend. The fund books it as dividend income or return of capital, depending on policy. But remember, leverage has increased. Track covenants and interest coverage. C. Convertible debt issued by portfolio. Split it into debt and equity components if accounting standards require. Value the conversion option. Revalue both each period. Model dilution for exit scenarios. D. Sidecar vehicle merges into the main fund. Promotion terms must be clear and documented. On merger, harmonize NAVs and capital accounts. Record adjustments properly. E. Positive EBITDA but negative cash flow. Say it simply. EBITDA ignores capex, interest, taxes, and working capital swings. Cash reflects reality. If inventories rise or customers delay payments, cash flow can be negative, even when EBITDA looks strong. 19. Governance, ethics, and LP communication. Trust is the lifeblood of private equity. GPs who lose it lose the ability to raise future funds. Some principles: related party transactions, always disclose fully. Prove arm's length terms. Get approvals. Negative NAV movements. Don't hide them. Explain drivers factually and outline mitigation. Early redemption requests. Closed-end PE funds are not liquid. Follow the LPA strictly. Quarterly letters. Keep them consistent. Show KPIs. Progress against strategy and risk items. Remember, the quality of your communication equals the quality of your governance. 20. Final checklist you can use tomorrow. Here's a simple 6-point checklist for any fund professional. Do we have a written 100-day plan for each portfolio company? Are valuation memos audit ready, with calibration, sensitivities, and documentation? Are capital accounts reconciled, investor-wise, every quarter? Are fee and expense policies written and actually followed? Do we run a monthly covenant and liquidity dashboard? Are exit options mapped 12 to 18 months in advance, with target buyer lists? If the answer is yes to all 6, You are operating like a top-tier fund. Private equity is simple in principle, but demanding in practice. Raise money with integrity. Buy companies with discipline. Operate them with obsession. Exit with preparation. Do this consistently, and strong returns will follow. Thank you for learning with CandiMentor. For more resources, visit CandiMentor.com. Explore jobs, interview Q&A, know your company, and past interview questions.